Hey everyone, welcome to Options with Hans. I'm Hans Albrecht, your friendly neighborhood options trader. I was a pro options market maker for 15 years and an options income fund manager for a decade after that. $1 billion in option strategies managed over 3 decades. Please like and subscribe and grab my free ebooks down in the description. As always, this is for educational purposes only, your trade, your responsibility. And if you're okay with that, let's dig right into a kind of product that I don't like to trade often, but when the conditions are just right, they can be powerful. They should, however, be sized accordingly for higher volatility and risk, but the reward can be spectacular when they work out. Again, I think this is a little bit of an urgent theme. I think we're actually embarking on a new AI leg. I talked about it yesterday in a video. NVIDIA earnings are this week. They may not be the turning point, but they will give us some data on the health of the industry and the demand that is being seen out there for this leading chip name. So today, SOXL, the SOXL, the 3-time leveraged bull semiconductor product. Let's go through the what, where, when, and why. I'm excited about this one, so let's get into it. Okay, so what gives? Hans isn't negative about SOXL, so I'm going to show you guys a link to a couple of videos I did on the SOXL, which always elicits an interesting response for people who go, wow, I didn't really know that. So we'll talk a little bit about that today. We're not going to get super into it because I do that in that video. We want to really get to the idea, the theme. So we're going to set the stage today with leverage being an interesting kicker to a broader idea. So why not SOXL much of the time? We'll dive into that just a little bit. Still risky, but why SOXL right now? So we'll talk about option pricing, and then we'll get into my turbo trade. So let's take a look at SOXL itself. So this is the 3-time bull, right? So these are the directional products. They have bull and bear, but the one we're talking about today is the bull. So this is supposed to give you the performance of the SOXX, which is the New York Semiconductor Index, basically a holding of, I think it's about 30 companies. And so it gives you that daily performance 3 times the regular performance. So if the index goes up 1%, you should be getting roughly 3% of upside in the SOXL. So as we'll talk about, the important feature here is that they're really only trying to guarantee you that one individual day of performance. And as we'll see, a lot of up and down movement has an impact on these products. The SOXS, which we're not talking about today, is the bear version. So when semiconductors are going down, this is going to do well. When semiconductors are going up, the theory is that this is going to do well, and it does, right? It's not always perfect, but it essentially does what it should because they're rebalancing. There's a swap product that's associated. The underlying of this product that is run, it has to do with a swap product, and they have to continually rebalance the weighting of the individual names that they hold in there in order to guarantee you something very, very close to that 3 times leverage each day. So SOXL, we can see here, daily target of 300%. You've got your NAV, daily market price, which of course is very, very volatile, as you would imagine. Expense ratio of 0.89 of gross. So 8.9 gross, 0.75 net. So you kind of think about roughly 75 to 89 basis points per year to hold something like this. So this is what they charge you to run a beta kind of strategy, beta plus strategy, and to run the inner workings of this, all the stuff that happens behind the scenes. So really big volumes here, actually. It's been around since 2010, which is actually kind of interesting, considering I mean, of course, semiconductors have been around for a long time, but interesting. It's just gotten really, really hot. So cool that they've been around for 15 years. That's good, and you'll see why that history is led to really good daily volumes. So it says right here on their website, seek a return that is 300% for the bull for a single day. These funds should not be expected to provide 3 times or negative 3 times the return of the benchmark's cumulative return for periods greater than a day. So that's where some people get these a little bit wrong. They kind of look at it and they interpolate and kind of go, okay, I think we should be getting this amount if I see this kind of performance over several months. But as we're going to talk about, they're very path dependent. It really depends on that underlying movement in the index. these derive their value from that underlying index, from those underlying holdings. So it's the underlying movement that really, really matters here. So we can see, look at this, AUM, assets under management, just about the same as the SOXX, which is just the straight up no leverage version of this. So almost the same amount in there, which gives you an idea of how people are playing these things. People love that extra boost, that extra punch that you're getting from these products. And, in an area like semiconductors and perhaps in technology, different areas of technology, you're probably going to see this a little bit more, right? Because people aren't just excited about lots of beta, which you get with semiconductors or other themes, like tech type themes, but they want more, right? They want to really go faster and faster, right? Like that ride at the amusement park. Do you want to go faster? Well, these allow you to go very, very fast. So leveraged equities run by different companies in an ETF structure. So very easy to transact in and out every day. And something like this is going to have very, very good liquidity. So you generally, unless the market just starts breaking and there's extreme volatility, you're probably going to see pretty good spreads on a product like this on an ongoing basis. So why not SOXL? So this is something I've gotten into arguments about this on Twitter, on X, and about MSTX, and that's the version of this, kind of like the version of this for MSTR, MicroStrategy or strategy. And I'm kind of arguing with people saying, no, he's saying this is fantastic. What a fantastic way to generate option premiums. I said, well, that's very risky on a product like this that gets chopped up. Most people don't realize that they get chopped up by actual movement. So, and I remember he said, well, this thing can't go down. I said, wait, this thing could go down, 80, 90%. He said, no, that's not possible. Guess what? It went down 80 to 90%. Exactly. So these things really can get hurt in a certain kind of negative market. So you just have to be prepared for that. These are generally not considered buy and hold type products. They're for targeted strategic use, quick sort of ins and outs. Not to say that you can't do well if you kind of let it run. They have had very, very good runs, but you have to be very careful because in a choppy or mean reverting market, you're going to lose some value in this product due to path dependency. That's called volatility drag. You'll see it called leverage decay. And so basically, if the underlying goes up 5%, this thing's supposed to go up 15%. But then when the underlying comes back down to where it started, the leverage version is going to actually come back to a little bit lower than where it started. So even though the underlying index is back to where it started, you have now lost maybe 1.2, 1.4% on the underlying. That is leverage drag. That is essentially, in options speak, these products are short realized volatility. So when you're short something, it means when that thing happens, you get hurt. They're short realized volatility, which means lots of back and forth movement is going to chip away at that value because the underlying has to be rebalanced, right? So once this thing has the underlying has a 1% move, guess what? This product, the manufacturer, the person running, the company running this product has to now add a whole bunch more underlying exposure because otherwise the next day you have a 1% move, you're not going to get that 3% of the 1%. So they're constantly allocating more to the long side as these things go up. And then if it reverses and comes down, they actually have to de-risk because now they own too much and they're going to get too hurt on the way down. So they're really creating, that's what leads us to this 1-day performance guarantee, because for 1 day, they can allocate enough of the underlying semiconductor stocks in this product so that they know they're going to get either that upward move of 3 times the underlying index performance, or they're going to get a down move of 3 times. Remember, you can lose 3 times the index move, right? The semiconductor index move. So that's how they do it. There's a rebalancing, and that rebalancing, when there's a lot of up and down, it gets chopped up, and that's money that leaves forever. Think of that as like, you kind of, if you bought 30-day puts and they went to 0, it's gone. It doesn't come back. That doesn't mean this product can't come back, but it just means that there's an element of that choppiness from movement that now is removed from the NAV of this product. So it is prone, inverse products are like that too. They are prone to this NAV chop. as markets move around. So really the idea is that you kind of want to you want to get into these things when there's low realized volatility, sort of almost non-intuitive, right? You don't necessarily want to get into these things when option prices are like through the roof, because that means there's lots of movement and this thing is getting chopped to pieces. So it's like almost intuitive in a way. You want to get in when things start to look good, and that leads us to our next point. So the path is not clear. Now, why semiconductors? So we talked about the issues with these particular products. Why should we go near them now? So semiconductors for the win. So we are going to need billions of GPUs. Now, I put out a video yesterday on NVIDIA. It gets into a lot more detail. So I don't want to get super into the detail on NVIDIA per se, or the sort of grand, broad theme around NVIDIA. Let's talk about how this thing gets you diversified exposure to many other names. So not just NVIDIA, you've got a whole bunch of names in here that cross the stack of value in the semiconductor industry, right? So many certain semiconductors do different things, right? Some are more for training, some are more for inference, some are memory. So, there are many different things. Some go into Internet of Things, right? So edge, right? They want this knowledge, this inference to happen on the edge in a small device, in a sensor, right? As opposed to in a robot on a production line, right? So that's going to be a big opportunity. These little tiny versions of these chip structures, GPUs, perhaps, if you will, that are going to be able to lend themselves to small things, because small things are all around, right? Sensors, things like that are giving us data from all aspects of life and industry and companies and things like that, things that we do personally. Gathering that data and making some sense of it is going to be a really great opportunity out there. So this is a product that is going to be evolving, and having an investment in something like this is going to allow you to benefit from that, because some of those themes will be stronger than others at different times, right? So now we're moving into this inference, as I call it, right? So training is kind of giving AI 10 million pictures of a cat. The inference part is when you show it a picture of a cat and it goes, that's a cat, right? That's inference. That is going to lead us to monetization opportunities. That's kind of the sort of almost real world benefit, if you think about it, when companies are going, well, how do I make money from this AI stuff? It's not, NVIDIA makes it because they just sell stuff to anybody who wants to be a part of the gold rush. So that's the kind of cool thing for NVIDIA, is they are kind of the purveyor, the crack dealer, where everybody needs crack, and they are in a fortuitous position of being the supplier of that, as well as other companies, as we'll see. This deal with the Saudis was really huge. I think that's massive. They have tons of money, and they are now pivoting to something where you need a ton of money, but they're now going to get into data centers and AI full speed ahead. And I think it was a good move. Some people may disagree because of whatever, human rights, this and that. You'd rather side with the Saudis, partner with them. Otherwise, they're going to go to China. They're going to go do the deep seek thing, and you were really going to be making a big mistake. So, like it or not, this is the better move for semiconductors, and probably for the U.S. in general. Uh, Definitely say that's something that I would stand by. So deep stack for chips, so you don't have to bet on one. So let's take a look. Well, you've got all kinds of names in the SOXX. Remember, the SOXL is based on the SOXX. So you've got the chip designers, broad-based players. You've got NVIDIA, of course, AVGO. Those are really and AMD. Those have really been the sort of three major horsemen, I would say. Qualcomm's probably a little bit more. I think it's kind of an interesting one, because remember I talked about edge, right? So Qualcomm's about small chips, devices, things like that, goes into cell phones and things like that. That's going to be a real big opportunity as we start to get more AI into devices and that thing in your pocket, right? So that's a really big opportunity. So these names here are really the backbone of the semiconductor design world, right? NVIDIA, AVGO, they don't actually make the chips, they don't make GPUs. But they design that. That's really the secret sauce, is really in the design. They are fabless, right? They do not fabricate these things. So NVIDIA, of course, at the top, major player, but also known maybe a little bit more for training, but they're pretty full stack, so they're going to get into that inference a little bit more. Quite a number of their models getting into the inference. Broadcom, interesting, big IP portfolio and connectivity and custom chips and things like that. So involved with Apple, actually, so very important. AMD hasn't been doing as well, but coming back lately with everything else. And then Qualcomm Mobile and mPower, very much about power management. So many different sides to the semiconductor industry. And together, you could kind of look at this bunch as sort of the design of the brains of the semiconductor industry, but very leveraged to everything else. They're very, very good at that side of things. So let's take a look at Fab, okay, we said the first group, non-fab. They don't make the stuff. Who makes it? These guys, right? TSM, ASML makes these massive lithography machines, which are incredible. They're like $150 million per machine. They are absolutely crucial at this point to the semiconductor industry. It's a Dutch company. So TSMC, undisputed global chip making powerhouse, right? They manufacture chips for everybody. This is part of the concern of having so much concentrated. They are now pledging to invest in the US. That is very, very good news in terms of diversifying supply chains and things like that, which I think is extremely important. So they make chips for everybody, right? NVIDIA, Apple, AMD, Qualcomm, you name it, that's what they do. ASML, again, very important. You don't have ASML, you don't kind of have cutting edge chips. So again, another exceptionally important company. And then of course, capital equipment makers and of course, capital equipment makers, the sort of tool makers, right? These companies sort of supply the fabs like the TSMs with the gear that they need to build semiconductors. You need equipment, you need machines, you need all this stuff to get set up in your surgically clean areas, and these guys make a lot of that stuff. KLA, focusing on process control, inspection, etc. I don't want to spend too much time here. Lam Research, kind of surgical tools of chip making, basically, right? These sort of critical layers on a chip that they do very, very well, unique abilities. And then Applied Materials, very, very broad. They're almost involved in every stage of the chip making process, right? Etching, inspection. So CapEx cycle bellwether, when people are spending a ton on CapEx, these guys are going to be very, very important. So, and then memory focus, right? We've got MU there, Micron, of course, very, 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 US based, very important company. So let's continue on here. So we got this wonderful thing. If you guys want, there's going to be a link in the description, and you can get some of these slides and this particular slide here, which kind of gives you an idea of the different the different companies in the stack. And I want you to notice over here, companies not in SOXX. So it can't own everything, but these are also very important companies, right? This is why I'm invested in these as well. Not Google right now, but Amazon, and actually not Apple. I'm invested in Apple, but the important thing is we have got custom chips being made by all these companies right now. This can be a threat to a company like NVIDIA, because these guys are probably worried that over the next however many decades, they're going to be relying on a couple of companies, and they certainly have a lot of money, and they are actually making some good headway. Google TPU's been around for a while, so very, very important. Apple, definitely they know that inference at the edge in your pocket is very, very important, so they're focusing on that as well. So let's talk about the turbo trade. Okay, the turbo trade is what I'm thinking for this thing, and we're going to talk about why. So if we look at when I look at options, whether it's from the long side or the short side, income or otherwise, I always like to have an idea of where those option prices are, generally speaking. Are they high? Are they low? So we look at interesting things, IVP, IVR, et cetera. We want to have an idea. We don't want to pay too much. We prefer to pay a very, very little. So we want to have an idea of where we are in that spectrum of the last 52 weeks, but even further back than that. So we can see that this here, basically all you need to know here is very expensive on the top part of this this scanner, and then very cheaper as you go down towards this low IV rank. Over to the right is where the calls tend to get a little bit more expensive than the puts. And then when everything's on the left here, in that big sell-off we saw recently, all the names were basically plastered down on the left side here, which means the puts were just exploding in value as everyone was panicking and buying puts and screaming, you know, for their mothers. Every stock was basically plastered to the left. Now we've scattered out again as the market has come back, and suddenly, you know, there's opportunity for dispersion, stocks doing different things, as opposed to in a sell-off when everything correlates to one and everything gets ugly at once. So you can see here, we've got the SOXX with still fairly expensive puts versus the calls. I like that. So low option pricing, which doesn't get me as excited about income trades per se. And you can see the SOXL here as well. Still pretty expensive put pricing. I'm going to show you what that looks like right now. So let's take a look at the SKU here. SKU means, well, how expensive are the puts versus the calls? And this is going to come into play into the turbo strategy. So you can look at the S&P as a kind of benchmark for where there's fairly steep SKU most of the time. So especially when the markets are very, very weak, or sometimes when they're making highs and pushing up, sometimes that SKU can kind of pick up as well. But here you can see those out of the money puts trading at a higher option price, relative option pricing level, which we call implied volatility, than the out of the money calls, right? So part of that is, it's another video, but really it's kind of the calls get compressed by call selling and the puts get pushed up by sort of mandated buying protection, right? It just makes sense. It's, you know, demand driven on the left, supply driven on the right. So if we look at the SMILE graph, we can see it's more like a smirk. It's not really a smile. Smile would be a little bit more like this. So you know, steep puts, steep calls would be more of what we'd call a smile. Here you can see puts very, very expensive. Makes sense, right? Markets crash down, even though the downside gets quite, you know, generally expensive a good chunk of the time, which is where we get some of the benefit of being income traders. So let's take a look at the SOXL. So here's our SOXL. Let's take a look at June, for example. That's a little too close. Let's look at regular June. Let's add July. So we've got July. We can see the very, very steep downside. So the turbo is really kind of selling that expensive downside to fund some of the upside. So that's kind of where the benefit comes from. So if you think of it from a volatility edge standpoint, you're getting that edge, right? You're selling something expensive to kind of create some less expensive upside in a sense. Now, it's not risk-free because depending on how you sell that downside, you may be obligated to buy the stock at a lower level. But oftentimes people will look at that and say, well, yeah, I'll buy that stock at a lower level. But for now, I'd like to create some upside. So that's really what we're trying to do here. So we can kind of see these puts have been a little bit expensive lately. This anywhere down near the bottom of this chart is going to be calls expensive. So we're not insanely expensive, but we're kind of mid-range, kind of in that sort of fairly steep region. So what we're going to do. So number one, you have to be willing to own this thing with the strategy that I'm presenting, right? And so I started off saying, listen, I'm not a huge fan of these things, but as this thing's basing, as the narrative starts to improve, as the idea, as this consolidates, the idea starts to kick in where I believe the uses, the inference benefit to the economy is about to absolutely explode, which is going to play into productivity, profit margins, et cetera. A lot of disruption. There's going to be a lot of disruption out there. But this is going to be picks and shovels up and down the value stack, right? So if we look back and we sort of look at, well, okay, you know, we're not, you know, hitting rock bottom here. We've had a little bit of a run up and valuations aren't small. NVIDIA is a $3 trillion company, but, you know, it could be a $8, $9, $10 trillion company at some point. And I'm not Mr. Exaggerator. It's possible. It's just that important, right? These things are that important. So, you know, if we kind of have maybe a very reasonable run in SMH, which I think could be, you know, we could maybe get, or sorry, in the SOXX, I think we could go up 150%. Let's say we go up 150%, you know, maybe like the thing is with these products, as you get momentum, if you don't have too many little choppy periods in between, that starts to compound, right? So it starts to give you a little bit more of what you were expecting. Not always, and there's certainly no guarantee of that, because again, it's path dependent. really depends how we get from A to B as much as just getting from A to B, right? So that's kind of tricky to understand, but it's not just getting from A to B, it's how we get there. Is there a lot of chop? Are there a lot of massive sell-offs? Or is it relatively smooth with some sell-offs? You're going to get some sell-offs. There's no way you're going to have a big run in anything without profit taking at times and people getting excited that it's overdone. And so there's absolutely certain, and then macro and all this other stuff going on, political. So there's all kinds of stuff going on that's gonna come into play. But if we have this incredibly strong run in semiconductors, I think you could probably get maybe 7, 8 bagger out of something like SOXL. So let's take a look at the trades here on SOXL. If we do something like this, which would be okay, so we're sort of looking for this thing to maybe kind of get close to those new highs. Doesn't, looking at technicals on this, it can work, but you have to understand there's a lot more going on under the hood, as we've sort of been explaining. But I think, there's a chance if things go really, really well here, as expected, we could be, 60, 70 bucks easily. I think we could be 80 to 100 bucks. So let's say we get to 70. I put on this trade here. It's difficult to say how long it's gonna last. You may have to roll this trade at some point. But let's say you sold 10 of the Jan 12 puts, the Jan 2026 puts. You're gonna get about $2.58 for that, right? So this is gonna obligate you to buy SOXL down at 12, with it trading at 15.73. Now, what are you gonna do? You're gonna take that and you're gonna plow it into the 23 call. So the 23 call is a little bit higher than where we are now. But the idea is that once this momentum gets going, it's going to be hard to stop. It's going to be going in mostly one direction, I hope. So the idea is that we're financing this, right? So we're going to try to make on the income trade, all we're going to make is the 258, right? The most we can make is that $2.58. We're going to maybe buy that back if it gets down to 50 cents, 60 cents, something like that. If it does, probably doing well on this thing, right? Unless we're just sitting around for the next 8 months, which probably won't happen. And we're going to get into these ones around 264. So, I might, depends on how I sort of feel about this. I already have a lot of exposure to NVIDIA and a few other semiconductor names. Some similar structures, a little bit different. You can play this a little bit differently. You can create some protection down here as well. If you buy like a 9 or an 8 put or a 7 put, you can create a little bit of protection that prevents against this complete collapse of SOXL. But again, you want to size this appropriately, and it's a trade that you can kind of dip your toe into and certainly add as things kind of get stronger, right? One of the great sayings that I learned once was a great trader adds to good trades. They get out of bad trades fairly unremorsefully, and they add to good trades. Not always going to work, but every now and then it's going to be like a craps table. You just hit a hot table where you're rolling the right numbers for an hour, and that can turn into exponential wins. So we buy these for 252, your break even's 25 bucks. So what happens? If we get up to 60 bucks, 10 lots going to make you about 38 grand. And if you get up to 80 bucks, get about 58 grand. So basically these things are going to be worth, intrinsic at that point. But let's say we get up to, let's be conservative about it. We're going to go 70 minus the break even of 25. So you can make $45, right? That's your benefit right there. Make $45. Basically, divided by what you put it in there, you're making about 17 times your money. 17 times your money. And if things go really, really well, you could make 20 plus times your money, right? So that's kind of exciting, right? It's risky. You're playing something with an incredible amount of leverage, and you're adding leverage to it. In a smart way, though. In a smart way. That's why the turbos are kind of nice. They play that vol advantage, and it's kind of like you're getting that little bit of edge. And anybody who's done my programs knows that I'm always talking about edge, right? You're always looking for edge, wherever it might be. And so it's always nice to get that pricing edge. part of the reason the skew is very, is compressed to the upside is probably because of this leverage decay. And over time, that upside is going to get maybe a little bit sort of compressed. But if you can ever catch a truly epic run on the SOXX, on semiconductors, on AI, then this is something that could be pretty spectacular. Okay, so that's it, guys. That's the trade. Leave comments if you have anything that you like, that you don't like. Reach out to me. There's lots of information in the description, lots of ways to reach out, lots of ways to learn, lots of free stuff, free courses, free books. And then, of course, there's me if you want to get to know my methods a little bit more intimately, then by all means, come check us out. So everybody, safe trading, safe investing this week. I'm rooting for NVIDIA. And if it's really, really good, then we'll get a nice pop. I mean, I'm kind of thinking it doesn't even have to be that good, and we're going to make new highs in NVIDIA. But if it's really good and we start to see developments in the areas that I am looking at, this could be pretty spectacular. So anyway, size appropriately, and we'll see you guys in the next video. Okay, so here's a little bit of a game plan. So we're going to start with 10 contracts. I'd like to build it up to probably 30, maybe even 40. But for now, let's kind of see how things play out with NVIDIA. And on strength, if this narrative is really starting to take hold, I don't think there'll be a ton of evidence that what I'm thinking could happen is going to be revealed just suddenly. But I'm looking at a lot of other evidence outside of this. But this will be a good sign of stability, of continued prosperity for NVIDIA and that sector. And then the rest of the good stuff is really going to come, I think, at an exponential rate. So sell 10 contracts of the Jan 2026 $12 strike for around $258. Trade leg 2 is buy 10 contracts of the Jan 2026 $23 strike call for around $255. So below 12, we have this cash secured put that's basically going to obligate us to buy SOXL at 12. We have a full risk of $12. If SOXL were to go to zero, of course, we are going to be on the hook for the full $12. So that'll be $12,000 on 1,000 shares, which is 10 contracts. Above 23, we're effectively long 1,000 shares if we include the sort of finance from the cash secured put, right? So there's different ways to look at this. They're separate trades, they're complementary trades. Now, so the maximum gain on that cash secured put on 10 contracts is $2,550. You can make $2,500 on those. Now you've got this upside too, though, right? The gain on the call is going to be your strike plus the premium you paid. If you sort of back out this cash secured put, break even at $2,558. So let's take a look at the different scenarios. At $40, a $14,000 gain. At $60, a $34,000 gain on that $2,500 investment in the call. At 80, $54,000, right? So at 60, let's say at 60, we get to 60, which I think is for my scenario, I think is reasonable. 1,300% gain. At 80, we really juice it up to 2,100. So on 10 contracts, you could turn $2,500 into $54,000. On 30 contracts, you could turn $7,600 into $162,000. So there's money to be made in the meantime. So remember that the structure together sort of looks like this, right? It's a kind of synthetic long SOXL. And this is your expiry line. So this is how we should always think of things in terms of maximum risk. Don't think of your P&L line or your margin or whatever. That's not telling you what your real risk is. Your real risk is your expiry line, and SOXL potentially goes to zero, which I don't see, right? That's the whole basis for why I'm doing this, is that I see this as a very kind of bottomy area for semiconductors with maybe a little bit of downside. And that's why we build in this cushion of 25% to account for that. And then if it gets worse, well, then we have to react to that, right? We're not just going to sit there. So, but in the meantime, here's your magenta line that's going to show you that you're going to start making money right away. Maybe on the way up, we start to see a bit of vol compression, right? So that option pricing gets a little bit compressed. So we do have some long vega that could be at risk a little bit if that happens. I don't think that'll happen necessarily. But we start making money right away. So this is a position that, hopefully we're going to be in the position of power here and sitting on gains and figuring out at some point as it goes up where we can kind of adjust this position, right? Could roll up the calls. There are a number of things we can do to kind of sort of take some of the money off the table and just keep that upside, right? So this is something I don't necessarily want to get out of at some point, unless I have some very, very strong feeling that this was sort of a top. But right now, I think it's just going to be ride it and then kind of adjust it to continue to take advantage, kind of like I did on my MSTR recently, right? Like I didn't want to just sell my calls. I turned it into a spread and really grabbed a heck of a lot more upside. So if you reserve that for your very, very strong ideas, you just kind of want to keep in that trade, but at the same time take off some of the risk.